Hello and welcome to the weekly Forex Outlook at xm.com. I'm Maria Pachardez, and joining me is investment analyst Marios Hadjikyriacos. We'll be discussing the week ahead. So Marios, let's begin with the U.S. The dollar has been doing extremely well lately compared to its competition, which is more exposed to the virus fallout. Is the upcoming economic data likely to change this positive narrative for the dollar?
I don't think so. So the narrative lately has really been, first of all, the US economy was already much stronger than Europe or Japan or most of its other main competitors, let's say. And then we got the virus concerns and the effects that might have on foreign economies. Now, the US is the least exposed to China in terms of exports. Yes, the two have very close business ties, but Japan and Europe are much more exposed, export more to China basically as a percentage of their economy. So a severe slowdown in China would be felt much more in Europe and Japan. So the story really has been, if you're worried about the virus and the spillover effects, sell foreign assets and buy US assets. That has been driving dollar demand. Now, is that likely to change? I don't think so. I really don't see a catalyst on the horizon that can derail this dollar positive trend, especially because lately markets have been factoring in Fed rate cuts basically by year end. 1.5 rate cuts are already fully priced in by December, but the dollar has been moving higher throughout. So if expectations for an easing of monetary policy can't push the dollar lower, it's difficult to see what will. Maybe the biggest near-term risk for the dollar would be verbal intervention. If the Trump administration, or even better, the Fed come out and say something like, we are really concerned about the strength of the dollar. If it continues, it could hurt exports and so on. That could be the trigger, not for a reversal in the dollar, but perhaps for a corrective pullback.
Okay, now let's move on to Japan. There are fears that Japan's economy might take a bigger hit from the virus than investors initially thought. The yen suffered unexpected selling pressure lately, falling dramatically relative to the US dollar. What will next week's numbers tell us about the state of Japan's economy?
That's not doing very well. So GDP, the economy contracted very sharply in quarter four. Everyone was expecting a strong recovery in quarter one, but then we got this whole virus thing and the implications it might have on Japanese exporters. So it's looking more and more likely that we might get another negative quarter in quarter one. If that happens, that will be the definition of a technical recession. And most worrisome of all is that there's very little policy room for Japanese policymakers to counter a shock like this one. Monetary policy is exhausted, fiscal room is very limited, so it could be a dark period for the Japanese economy going forward. As far as the yen is concerned, yes, we have seen it collapse lately, but I will say this, that collapse was not mirrored in the bond market. Even though the yen fell, the bond market was more or less steady, relative interest rates. So usually when there's a divergence like that, it tends to correct. The question is, will the bond market move towards the FX market or will the FX market move towards the bond market? Usually it's the latter. Usually it's the yen that moves back towards relative interest rates. So in that sense, I think that there's an argument to be made for a recovery in the yen before very long.
And finally, next week will be an interesting one for commodity currencies. What can we expect to see there?
Well, it's a busy data week. We get capital expenditure data from Australia. We get GDP numbers for quarter four out of Canada. All of this data, though, are for quarter four. So I think they are going to be viewed by the market as a little outdated. It was before this whole virus theme emerged. So even if those economies were doing fine in quarter four, who knows what the real situation is right now after the virus slowdown in China. So I think that the markets will be much more focused on any February data to gauge the impact of the virus. Now, as far as the commodity currencies are concerned, we've really seen the Aussie and the Kiwi plunge lately. The Aussie is at a fresh 11-year low today. Now, that is mainly reflects expectations that the slowdown in China will be long-lasting, in my opinion. Lately, the market has shifted from the view being that this will be a short-term shock. It will hit the Chinese economy, but we will see a quick rebound. That kind of thinking has given way to, yes, but it could be extended, and if it is extended, then the impact on export-heavy economies like Australia and New Zealand might be much more pronounced. Now, we haven't seen the loonie collapsed lately, or at least its decline hasn't been as severe as the drop in the Aussie and the Kiwi, and I think that has to do with how much more exposed the Australian and the New Zealand economies are to China. Is there a saving grace on the horizon? I'm not really sure. They have already collapsed quite significantly, but I don't see a positive catalyst on the way that can trigger, a sustainable recovery in the Aussie or the Kiwi.
Marius, thanks so much, and thanks for joining us at XM.com.